Before we begin, a brief word. If you value thoughtful, disciplined financial analysis that cuts through the noise and focuses on what truly matters, I invite you to subscribe to this channel. Subscribe button in red. We don't chase headlines. We don't promise overnight wealth. What we offer is clarity, context, and rational strategy during times when emotions run high and decisions become difficult. Now, let's discuss something important. Geopolitical conflict is unfolding between the United States and Iran. Markets are reacting. Volatility is rising. Oil prices are moving. Defense stocks are shifting. Investors everywhere are asking the same questions. What does this mean for my portfolio? Should I act? Should I wait? Here's what most people won't tell you. Crisis creates both danger and opportunity, but only for those who understand what's actually happening beneath the surface. This isn't about speculation. It's not about gambling on headlines. It's about recognizing patterns that have repeated throughout financial history, understanding how markets respond to geopolitical stress, and positioning yourself with intelligence and discipline. Over the next 25 minutes, we're going to examine this situation through the lens of rational financial strategy. We'll explore how geopolitical conflict affects different asset classes. We'll look at historical precedent. We'll discuss investor psychology and why most people make costly mistakes during these periods. And we'll outline specific, actionable approaches for both existing asset holders and those considering new positions. This is serious analysis for serious investors. Let's begin. When geopolitical tensions escalate between major powers, financial markets don't simply react to the news itself. They react to the implications, the uncertainty, and the potential disruptions to global economic systems. The US-Iran conflict represents more than a bilateral dispute. It sits at the intersection of energy security, Middle Eastern stability, global supply chains, and military positioning. Iran controls strategic waterways. It influences regional politics across multiple nations. It sits on massive energy reserves. Any conflict involving Iran immediately raises questions about oil supply, shipping routes, and broader regional stability. Markets hate uncertainty, but markets also hate disruption to critical systems. This situation contains both. In the immediate aftermath of escalating tensions, we typically see predictable patterns. Energy prices rise. Defense sector stocks gain attention. Safe haven assets like gold and treasury bonds see increased demand. Risk assets, particularly equities in sensitive sectors, experience volatility. These are reflexive moves. They're driven by fear, speculation, and rapid repositioning. Some of these moves are rational. Many are not. The critical question for intelligent investors isn't what happened in the first few days. It's what happens next, and how to position for various scenarios over weeks and months. This isn't the first time geopolitical conflict has created market turbulence. It won't be the last. Look at the Gulf War in 1990-1991. Oil prices spiked dramatically when Iraq invaded Kuwait. Markets sold off sharply. Fear was widespread. Yet within months, as the situation clarified and military intervention proceeded quickly, markets recovered and went on to significant gains. Consider the 2003 Iraq War. Markets were nervous leading up to the conflict. Uncertainty was high. But once actual military action began and the initial phase proceeded according to plan, markets rallied strongly. Or examine the various Iran-related tensions over the past 2 decades, the 2012 oil embargo threats, the 2019 tanker attacks, the 2020 Soleimani strike. Each created short-term volatility. None fundamentally altered long-term market trends. The pattern is clear. Initial fear creates opportunity. Sustained conflict creates complexity. Resolution and/or adaptation creates recovery. When analyzing this situation, consider 3 broad scenarios. First, de-escalation. Diplomatic channels work, tensions cool, military action remains limited. Energy markets stabilize, risk assets recover. This has been the most common outcome historically. Second, limited conflict. Some military engagement occurs but remains geographically contained. Regional disruption is moderate. Energy prices remain elevated but manageable. Markets adjust to a new normal. Economic impact is significant but not catastrophic. Third, major escalation. Widespread regional conflict. Significant disruption to oil supplies, potential involvement of other powers, severe economic consequences, market dislocation. This is the low probability but high impact scenario. Smart investors don't bet on one outcome. They position for multiple scenarios with appropriate risk management. During geopolitical crisis, the majority of investors make predictable mistakes. They panic and sell near the bottom. They chase momentum into sectors that have already moved. They overconcentrate in safe assets at precisely the wrong time. They abandon their strategy and make emotional decisions. Why does this happen? Because geopolitical conflict triggers our most primal fears. Fear of loss, fear of the unknown, fear of catastrophic outcomes. These fears are natural, they're human, but they're also the enemy of rational investment decisions. Many investors today have limited experience with major geopolitical conflict during their investing careers. The post-2008 period has been relatively stable from a military conflict perspective. Yes, there have been tensions and smaller engagements, but nothing like the major wars that defined earlier decades. This creates recency bias. When conflict does emerge, it feels unprecedented. It feels uniquely dangerous. The emotional response is amplified. But history tells a different story. Markets have weathered world wars, regional conflicts, terrorism, and nuclear standoffs. They've demonstrated remarkable resilience when the underlying economic system remains functional. Here's what makes this challenging. The best opportunities often appear when things feel the most dangerous, when headlines are screaming conflict, when talking heads are predicting doom, when your emotional brain is telling you to run for safety. That's often when assets are being priced for worst-case scenarios that never materialize. The opposite is also true. When everyone feels confident, when conflict seems safely resolved, when markets have recovered fully, that's often when future risks are being underpriced. This paradox explains why disciplined investors outperform during volatile periods. They do what feels wrong. They act counter to their emotions. They follow process instead of impulse. Understand that modern media amplifies both the perception and emotion of crisis. 24-hour news cycles need content. Social media spreads fear rapidly. Every development, no matter how minor, receives intense focus. The volume of information creates the illusion that things are worse than they are. This doesn't mean the situation isn't serious. It means your emotional response is being manipulated by information overload and presentation bias. Smart investors filter signal from noise. They focus on material developments, not minute-by-minute updates. They think in weeks and months, not hours and days. Energy is the most obvious area of impact. Let's think this through carefully. Iranian conflict threatens oil supply through multiple channels. Direct production disruption, threats to shipping through the Strait of Hormuz, potential regional instability affecting other producers, possible supply chain impacts on refined products. When oil prices spike due to geopolitical risk, several things happen simultaneously. Energy company revenues increase, but so do their operating risks. Some companies benefit tremendously. Others face challenges depending on their geographic exposure, hedging strategies, and operational profiles. The key insight: not all energy investments respond the same way. Major integrated oil companies, independent producers, service companies, renewable energy firms, and energy infrastructure all have different risk-reward profiles during conflict. Furthermore, oil price spikes driven by fear often reverse quickly if actual supply disruption doesn't materialize. Timing becomes critical. Entry points matter enormously. Defense contractors often rally during military conflict. This response is logical but frequently overdone. Yes, conflict increases defense spending priorities. Yes, existing contracts become more secure. Yes, new procurement may accelerate. But most defense companies already have substantial order backlogs. Revenue doesn't change overnight. Contract awards take time. And much defense spending is driven by long-term strategic priorities, not short-term conflicts. The investors who profit from defense stocks during crisis are usually those who owned quality companies before tensions escalated. Chasing defense stocks after they've already surged on conflict news often leads to disappointing results. Gold, treasury bonds, the dollar in certain contexts, these traditionally serve as safe havens during geopolitical stress. Gold particularly tends to rise when geopolitical risk increases. It's a store of value that exists outside the financial system. It benefits from both fear and potential inflation from energy price increases. But gold is also volatile, produces no cash flow, and can reverse sharply if tensions ease. It's insurance, not necessarily investment. Treasury bonds offer safety, but at the cost of low yields. During crisis, investors pile into treasuries, driving prices up and yields down. This provides capital preservation, but limited return potential. The question isn't whether safe havens have a role. It's how much exposure makes sense given your overall strategy and risk tolerance. Broader equity markets face cross-currents during geopolitical conflict. On one hand, conflict creates uncertainty, potential economic disruption, and risk aversion, all negative for stocks. On the other hand, many companies have limited direct exposure to conflict zones. Corporate America continues operating. Consumer spending persists. Technology advances. Healthcare treats patients. The underlying economic engine keeps running. History shows that major equity indices often recover from geopolitical shocks within months, sometimes weeks. The 2020 pandemic is an extreme example. A massive shock followed by rapid recovery. The critical factor is whether conflict actually damages underlying economic fundamentals or merely creates temporary fear. Emerging market assets often suffer disproportionately during geopolitical crisis. Risk-off sentiment hits these markets hard. Capital flows reverse, currencies weaken, political risk premiums expand. Yet this creates asymmetric opportunities. High-quality emerging market companies and bonds become available at compelling valuations. For investors with appropriate risk tolerance and time horizon, these dislocations can generate substantial long-term returns. The key is distinguishing between countries and companies directly affected by conflict versus those simply caught in broad risk aversion. Currency movements during conflict are complex and often counterintuitive. The dollar sometimes strengthens as a safe haven. Sometimes it weakens if conflict undermines U.S. economic prospects or global stability. Oil exporting currencies may gain. Currencies of countries dependent on energy imports may suffer. For most investors, direct currency speculation isn't advisable, but understanding currency dynamics helps evaluate international investments and explains some of the volatility in foreign asset returns. If you already own a diversified portfolio constructed according to sound principles, your first instinct should be to do nothing. Panic selling during crisis locks in losses and forfeits the recovery. This pattern has destroyed more wealth than any other behavioral mistake. Your portfolio is presumably built to withstand volatility. Market downturns are a feature of investing, not a bug. If a 10 or 15% decline forces you to sell, your portfolio was too aggressive to begin with. The exception, if you've discovered that your risk tolerance was misjudged and you genuinely cannot sleep at night, then reduction makes sense. But this should be a measured, thoughtful decision, not a panic response. Market volatility creates rebalancing opportunities. If your equity allocation has fallen below target due to price declines, rebalancing means buying stocks at lower prices. If safe assets have risen above target, rebalancing means selling high. This is mechanical. It's emotional difficult. It forces you to buy what feels dangerous and sell what feels safe. But it's also mathematically proven to enhance long-term returns. Don't rebalance daily or weekly, but quarterly or semi-annual rebalancing during volatile periods can be powerful. If you hold positions showing losses, consider tax loss harvesting. Selling declining positions to realize losses for tax purposes, then purchasing similar but not identical securities allows you to maintain market exposure while creating tax benefits. This is technical but valuable. Work with a tax professional. The savings can be substantial, particularly for high-income investors. Some investors respond to crisis by dramatically increasing safe asset allocations or purchasing complex hedging instruments. Unless you're extremely sophisticated and wealthy, complex hedges are probably not appropriate. They're expensive, difficult to implement correctly, and often provide false comfort. Simple hedges like modest gold allocations or maintaining larger cash reserves make more sense for most investors. The goal isn't to eliminate all risk. That's impossible. It's to manage risk to acceptable levels while maintaining upside participation. Use this volatility to examine your holdings critically. Which companies have strong balance sheets and can weather disruption? Which are over-leveraged and vulnerable? Which sectors face genuine structural threats versus temporary headwinds? Crisis reveals quality. Weak companies and sectors struggle. Strong ones prove resilient. This information is valuable for long-term portfolio construction. You might discover that some holdings you thought were solid actually face serious challenges. Better to recognize this now and make thoughtful adjustments than to hold stubbornly and realize the problem too late. Geopolitical conflict often exposes concentration risk. If you're heavily concentrated in a single sector, geography, or theme that's particularly vulnerable, volatility will be painful. This pain provides valuable information about whether your position sizing is appropriate. Diversification isn't about eliminating risk. It's about ensuring that no single position or theme can destroy your financial plan. Use this period to honestly assess whether your portfolio achieves this. If you have capital to deploy in a long-term time horizon, market dislocations create opportunity. Asset prices reflect not just fundamental value, but also sentiment, positioning, and forced selling. During crisis, sentiment swings to extremes. Forced selling occurs as leveraged investors, risk parity funds, and panic-driven individuals exit positions. This creates mispricings. High-quality assets become available at prices that don't reflect their true long-term value. This is where patient capital compounds wealth. But, and this is critical, you must have genuine long-term patience. If you'll need this capital in 6 months or even 2 years, this approach doesn't work. Market bottoms can take time. Recovery can be frustratingly slow. If you're building positions, consider systematic approaches over time. Trying to time the exact bottom is impossible and unnecessary. Investing in regular increments over weeks or months ensures you capture lower prices without requiring perfect timing. This approach also manages the emotional challenge. Committing all capital at once during crisis feels terrifying. Systematic investment feels more controlled and manageable. The math works, the psychology works. For most investors, this is superior to trying to pick the perfect entry point. Which sectors deserve attention during this period? Look for areas with fundamental strength but sentiment-driven weakness. Technology companies with strong balance sheets, recurring revenue, and limited conflict exposure. Healthcare companies serving essential needs, consumer staples with pricing power. Avoid areas with genuine structural challenges disguised by conflict-driven volatility. Highly leveraged companies. Sectors already facing disruption. Companies with significant exposure to worst-case scenarios. The question isn't whether prices are down. It's whether the decline reflects temporary fear or permanent impairment. During market stress, everything gets cheaper. But cheap isn't always opportunity. Value traps are companies that appear inexpensive but face real problems. Declining industries, poor management, technological obsolescence, unsustainable business models, these don't become good investments just because they're down 30%. Focus on quality, strong competitive positions, pricing power, competent management, reasonable leverage, products or services with enduring demand. These companies temporarily repriced due to fear represent genuine opportunity. Consider geographic exposure carefully. U.S. markets may face direct impacts from conflict, but also benefit from safe haven flows. European markets may suffer from energy dependence. Asian markets may face indirect effects. Emerging markets may offer value, but carry elevated volatility. No single geography is obviously superior. Diversified exposure with understanding of specific risks makes sense for most investors. Holding cash during volatile periods isn't cowardice, it's optionality. Cash allows you to act when opportunities become compelling. It provides psychological comfort that enables rational decision-making. It ensures you're not forced to sell other holdings at disadvantageous times. The cost is opportunity cost, returns you might have earned if fully invested. But this cost can be far less than the cost of panicked selling or the benefit of buying at severely depressed prices. Appropriate cash levels depend on individual circumstances, but most investors benefit from some dry powder during uncertain times. The single biggest destroyer of investment returns is emotional decision-making. Selling in fear at market bottoms, buying in euphoria at tops, abandoning long-term strategy based on short-term headlines, letting anxiety dictate actions instead of process and principle. Every experienced investor has made these mistakes. The key is recognizing the pattern and implementing safeguards. Wait 24 hours before making major portfolio changes. Discuss significant moves with a trusted advisor or knowledgeable friend. Write down your reasoning and review it before acting. These simple steps prevent most emotional errors. Using margin or other leverage during volatile periods is extraordinarily dangerous. Leverage amplifies both gains and losses. During crisis, volatility spikes and correlations shift. Positions that seem safe can move violently. Margin calls force selling at the worst possible times. Countless investors have been destroyed not by bad investments, but by excessive leverage at the wrong time. If you're using significant leverage, this is the time to reduce it, not increase it. Some investors respond to crisis by concentrating in perceived safe assets or speculative opportunities, going all in on gold, putting everything in treasury bonds, betting heavily on defense stocks or energy plays. These concentrated positions feel decisive and strong. They're actually reckless. Diversification is your protection against being wrong, and you will be wrong about something. Maintaining diversified exposure across assets, sectors, and geographies is essential precisely when it feels unnecessary. Investment decisions must match your time horizon. This sounds obvious, but is frequently violated during crisis. If you need capital within 2 years, taking significant equity risk is inappropriate regardless of opportunity. If you have 20 years, panicking over 12-month volatility is irrational. Align your actions with your timeline. Don't let short-term market moves drive long-term capital to behave like trading capital. When everyone is doing the same thing, whether buying or selling, that's usually the wrong time to join. Crowds are driven by emotion and momentum, not analysis. When the crowd panics, prices overshoot to the downside. When the crowd stampedes into something, prices overshoot to the upside. The greatest opportunities exist in what the crowd is fleeing. The greatest risks exist in what the crowd is chasing. This requires courage. It feels wrong. It is, nonetheless, how wealth is actually built. Some investors respond to volatility by dramatically increasing activity, watching markets constantly, making frequent trades, constantly adjusting positions. This feels productive. It's actually destructive. Trading generates taxes and fees. It turns long-term gains into short-term gains taxed at higher rates. It increases the probability of buying high and selling low. It creates stress and anxiety. Most investors would achieve better results by dramatically reducing activity, not increasing it. During volatile periods, various costs become amplified. Bid-ask spreads widen. Premium options carry higher prices. Fund fees compound losses. Trading costs add up quickly with frequent activity. Pay attention to the cost of every decision. Sometimes, the smart choice is simply to avoid unnecessary transactions and their associated costs. Investment decisions have tax consequences that significantly impact actual returns. Selling winners generates capital gains taxes. Short-term gains face higher rates than long-term. Loss harvesting creates benefits, but has rules and limitations. Never let taxes be the primary driver of investment decisions, but never ignore them either. After-tax returns are what actually matter for building wealth. Let's zoom out and look at history with clear eyes. The world has endured 2 world wars, countless regional conflicts, nuclear standoffs, terrorism, assassinations, and persistent geopolitical tensions throughout the modern investing era. Markets have weathered all of it, not without volatility, not without painful drawdowns, but ultimately, markets have reflected economic growth, innovation, and human progress. The S&P 500 has survived Pearl Harbor, the Cuban Missile Crisis, Vietnam, multiple Middle Eastern wars, 9/11, and countless other shocks. It has delivered roughly 10% annual returns over the long run despite these challenges. This doesn't mean every conflict resolves positively. It doesn't mean recovery is guaranteed in months, but it does suggest that betting against human resilience and economic adaptation has been a losing position historically. Here's what often gets lost during geopolitical crisis. The underlying economy continues functioning. People go to work, companies produce products, services are delivered, technology advances, businesses solve problems, commerce continues. Yes, conflict creates disruption. Yes, there are costs and consequences. But unless conflict fundamentally breaks the economic system, the engine keeps running. This is why markets often recover faster than emotional investors expect. The gap between scary headlines and actual economic impact is usually significant. Short-term market moves are driven by sentiment, fear, and positioning. Long-term returns are driven by valuation and fundamentals. If conflict causes high-quality assets to become significantly undervalued, those assets will eventually recover as fear subsides and fundamentals reassert themselves. This can take time. It requires patience. But mean reversion is a powerful force. Extreme valuations, either expensive or cheap, tend not to persist. The investors who build substantial wealth over time don't do it through perfect timing or spectacular individual trades. They do it through consistent participation, emotional discipline, and the power of compounding. They stay invested through volatility. They add capital systematically. They avoid catastrophic mistakes. They let time and compound returns work. Every crisis feels different. Every crisis creates the temptation to abandon this approach. And every crisis, historically, has ultimately rewarded those who maintain discipline. The concept of anti-fragility, systems that gain from disorder, applies to investing. A portfolio that's appropriately diversified, not over-leveraged, and composed of quality assets doesn't just survive volatility. It benefits from the opportunities volatility creates. This requires upfront work, careful construction, appropriate risk management, honest assessment of your own psychology and time horizon. But once built, an anti-fragile portfolio allows you to view crisis not with fear, but with confidence. Before making any significant portfolio change, ask these questions. Am I acting on analysis or emotion? If you can't articulate a clear, logical reason for a decision beyond "I'm worried" or "everyone is doing it," don't act. What's my time horizon? If this capital isn't needed for years, short-term volatility shouldn't drive decisions. If it's needed soon, it shouldn't be at risk regardless of opportunity. Am I trying to predict or prepare? Prediction is impossible. Preparation through diversification and risk management is essential. Would I make the same decision if markets were calm? If the answer is no, you're probably responding to fear rather than reason. What's my downside if I'm wrong? Every decision involves risk. Can you tolerate the worst-case outcome? If not, adjust accordingly. Consider organizing capital into 3 mental buckets. Bucket 1, safety and liquidity. Capital needed within 2 years. This stays in cash, short-term bonds, or other stable assets, regardless of market opportunity. Conflict doesn't change this bucket. Bucket 2, core long-term holdings. Diversified portfolio of quality assets. This bucket stays invested through volatility. Rebalancing occurs systematically, but wholesale changes do not. Bucket 3, opportunistic capital. Truly long-term money that can take concentrated risk on compelling opportunities. This bucket can be more aggressive during dislocations, but only with genuine patience. This framework prevents mixing time horizons and risk profiles, which is where most mistakes occur. Don't make portfolio decisions in the heat of the moment. Create a plan in advance. Determine your rebalancing triggers. If equities fall X% below target, I'll buy. If they rise X% above, I'll sell. Make this mechanical. Identify your opportunity threshold. If high-quality companies I've researched fall X%, I'll establish positions. Define this before emotions are high. Set your risk limits. I will not use margin above X level. I will not let any single position exceed X% of portfolio. Establish boundaries. Document your reasoning. Write down why you own what you own and what would change your thesis. This prevents reactionary decisions based on temporary volatility. For many investors, particularly those with substantial assets or limited experience, professional guidance adds enormous value during volatile periods. A good financial advisor doesn't predict the future. They provide process, discipline, and emotional ballast when you need it most. They prevent you from making the catastrophic mistakes that destroy wealth. If you work with an advisor, this is when their value is highest. If you don't, consider whether you have the knowledge, discipline, and emotional fortitude to navigate alone. There's no shame in seeking help. The most successful investors often have teams supporting them precisely because they recognize the value of external perspective and process. Whether this particular US-Iran situation escalates, stabilizes, or resolves, the meta lesson remains constant. Geopolitical risks are permanent features of investing. They will always emerge. They will always create volatility. They will always tempt emotional responses. Your goal isn't to avoid these situations. You can't. Your goal is to build an approach that handles them rationally. This means appropriate diversification, conservative use of leverage, honest understanding of your risk tolerance, commitment to process over prediction, patience, and discipline when emotions run high. These principles apply to US-Iran conflict. They apply to the next crisis. They apply to the crisis after that. Geopolitical conflict is one type of risk, but intelligent investors consider the full spectrum. Inflation or deflation, interest rate changes, recession, technological disruption, regulatory shifts, currency movements, credit events, pandemic, cyber warfare, climate impacts. Any of these could create the next crisis. The specific trigger matters less than your preparedness for volatility in general. Don't become myopically focused on one risk while ignoring others. Broad-based resilience is what actually protects wealth. Markets move in cycles. Bull markets create complacency. Bear markets create fear. Geopolitical calm creates confidence. Geopolitical conflict creates panic. Understanding that you're in a cycle, not a permanent new reality, is psychologically powerful. This too shall pass. Not because conflict is trivial, but because markets and economies are adaptive systems. They adjust, they find equilibrium, they move forward. Your advantage comes from maintaining perspective when others lose theirs. We've examined the US-Iran conflict through a clear-eyed financial lens. We've discussed how markets respond to geopolitical stress, both immediately and over time. We've explored different asset classes and their dynamics during crisis. We've outlined approaches for existing holders and potential investors. We've identified critical behavioral mistakes that destroy returns. Most importantly, we've established framework over prediction. We can't know exactly how this situation unfolds. We can prepare for multiple scenarios with appropriate risk management. Let me restate what matters most. Stay rational when others panic. Process beats emotion every time. Maintain appropriate diversification. Your protection against uncertainty is not predicting the future, but preparing for multiple outcomes. Match decisions to time horizons. Short-term volatility doesn't matter for long-term capital. Quality over quantity. A few excellent investments beat dozens of mediocre ones. Manage costs and taxes. These silent killers of returns compound against you over time. Avoid leverage and concentration. These amplify both gains and losses, usually at the worst possible times. Focus on what you can control. You can't control geopolitics. You can control your response. If your goal is building substantial wealth over decades, and it should be, then moments like this are tests of character and discipline. The investors who achieve financial independence aren't those who perfectly timed every market move. They're those who stayed invested through volatility, added capital systematically, avoided catastrophic mistakes, and let compound returns do their work. Every crisis creates the temptation to abandon this path. Every crisis generates fear that this time is different and long-term investing no longer works. And every crisis, ultimately, rewards those who maintained discipline and patience. Here's what I want you to understand. You have more control than you think. You can't control whether geopolitical conflict escalates. You can't control whether markets rise or fall tomorrow. You can't control headline news or other investors' reactions, but you can control your process. You can control your risk management. You can control your emotional responses. You can control whether you act on fear or reason. These things you control are precisely the things that determine long-term success. So what should you do right now? Review your portfolio with fresh eyes. Is it constructed for volatility? Are you over-leveraged? Are you properly diversified? Does it match your actual risk tolerance and time horizon? Make a plan. Don't wait for the next crisis moment. Define your rebalancing rules, your opportunity thresholds, your risk limits now while emotions are manageable. Educate yourself continuously. Read history. Study market cycles. Understand behavioral finance. Learn from others' mistakes. Knowledge is your greatest defense against panic. And then, most importantly, execute with discipline. Follow your plan. Trust your process. Resist the urge to constantly tinker. Let patience and compound returns do their work. Financial markets will continue experiencing volatility. Geopolitical risks will persist. Unexpected events will create fear and uncertainty. But through all of this, the fundamental principles of wealth building remain unchanged. Own quality assets, maintain discipline, manage risk appropriately, think long-term, and avoid catastrophic mistakes. The investors who internalize these principles don't just survive crisis, they use crisis to accelerate their progress while others stumble. This isn't about being the smartest person in the room. It's not about perfect predictions or spectacular trades. It's about being more rational, more patient, and more disciplined than the crowd. That advantage is available to anyone willing to do the work. Thank you for investing 25 minutes in serious financial education. If this analysis provided value, I encourage you to subscribe to this channel for continued thoughtful discussion of complex financial topics. Subscribe button in red. We don't chase clicks. We don't promise easy wealth. We provide clarity, context, and rational strategy for building lasting financial security. Until next time, stay disciplined, stay focused, and remember, the greatest opportunities often emerge when others are paralyzed by fear. The path forward is clear for those willing to see it.